when we start looking at setting up to get into that retirement mode, the one thing that we always try to remind our clients is that when you retire, you stop working, and guess what happens? That valve on that beautiful income stream turns off. So what do we do at that point? How do we create some additional income to be able to make you smooth sailing right into retirement? The main focus that we look at with your income is you don't want to change your standard of living that much, so we need to find out what the basic needs, what that income looks like, how those bills, how month to month everything gets paid. The idea is that if we can take that income portion and protect it and keep it where all the dollars can come for income, then we're able to manage the money in the markets. Your investments will allow them to grow and keep up with the cost of living. The protected side, they keep the flow of your income, and it's always protected. Kind of what we talked about when we look at the two buckets of income, one the protected. What we try to do with the managed money side is that's where we're going to, fight the inflation. We'll get the cost of living increases, and then as we have good years, we're able to pull additional dollars in. So the problem that we see with the 4% rule is, they've always told us to max out your 401k, diversified mutual funds, and they always tell us to take that pre-tax deduction because they knew we'd be in a lower tax bracket at retirement. Funny thing is, that's really not happened to most people. If you've saved wealth over the years, you're going to go into higher tax brackets with these RMDs. The experts are now telling us that that might not be a safe number, that we look at more like maybe a 2.8, possibly a 3%. So all of a sudden, you're taking less dollars out, hoping that you don't run out of money. There's a lot safer ways to do this. It's easier for us to just create that pension-like income through a protected source. The whole concept of being able to pull income safely is when we look at annuities, we can use that as that pension-like income that you probably aren't receiving anymore. And then we always want to try to tackle the IRA, the traditional money, first to try to start getting those taxes down. Obviously, the Roth is going to be tax-free, so we kind of let that stand. Maybe that's for legacy purposes. The main idea behind the RMD penalties is it used to be 50%, now it's 25%, which is crazy high. Wherever those monies are, we will verify and we do double checks on it just to make sure that the correct amount's done each year. The monies that we have in the income with the qualified monies is real easy because the insurance company's basically telling us how much that we need to pull out. So when we look at Roth conversions, one of the strategies that we use is to actually use other people's money and collect a bonus on being able to move into say, annuity that we pull 15-20% bonus into, and then we pay the taxes with those dollars. If we structure it over a 3 to 5 year period, then all of a sudden we can stay in those same tax brackets, but start narrowing down, getting those taxes paid off in a timely, strategic manner. We always refer back to kind of 2008 where, everything was going strong, the markets were good. I mean, we saw that hiccup in the dot-com era, but in 2008, all of a sudden, we had people that were they were pulling $20,000, $30,000 out of their investment accounts, and at the same time they were losing 20, 30, 40% in their accounts. The idea is that if we can strategically get your money into separate buckets, then we can use those buckets to make sure that we maintain the proper income coming in each year and be able to have that happy retirement, smooth sailing. There's a lot of different ways to do it. If you talk to 50 different money managers, advisors, you're probably going to get 50 different ways to do it. So it's always good to at least get that second opinion, talking to another advisor. But the idea is that we don't want all of our money in any one bucket. We want to be able to separate your dollars and have those buckets serving a purpose, whether it's for cost of living adjustments, for guaranteed income in the retirement stage, or if it's just for liquidity needs for emergency. So we'd love to share with you our thoughts, our strategies, and please give us a call so we can set up a visit.